planning to discuss Chapter 10. I was hoping it would be warm outside by the time you got to this chapter, so in the spirit of that, I brought out the short sleeve gear today. No baseball. Hopefully the market's settled down and coronavirus fears have subsided. But regardless, we still need to learn our accounting. So let's get into Chapter 10. Remember, you can send me emails. I will be around campus if you need to see me. Okay, so you got to let me know. But email me questions. I'll put them together. I'll get them back to the class. Let's not mess things up on this final. You'll get a practice set just like last time. I may do a video on the practice set for you. We'll see how things progress, which you'll be able to have with you when you're taking your final exam. The only thing I don't want you to have when you're taking your final exam is another student next to you. Other than that, open book, open lecture notes. You can have the video running, practice set. I don't care, all right? Of course, if you know the material, you'll be able to finish the exam in the required allotted time. If you really had to look everything up, there's no way you'll finish. So you kind of got to know the material. We'll try and make sure you know it. Someone get back to me, let me know that the videos are working. They seem to be for my finance class. And with that, let's start on Chapter 10, Decentralized Operations. Okay, I wonder today if I'll get more questions than I normally do during class. Just kind of kidding there. Maybe some email questions. But anyway, why decentralized operations? What does decentralized operations mean? Okay, first of all, it means we're allowing lower level management, supervisors, work coordinators to make some decisions and have some input. It's not heavy-handed from the top. That's what this chapter is suggesting, okay? And they're going to give us some tools to help facilitate to see if those lower level managers are succeeding at what they're implementing, all right? So decentralized versus centralized. Centralized would mean the CEO helps set the budget and everything. It comes down, everybody knows exactly what they got to accomplish, and they're told how they're going to accomplish it, okay? Decentralized, we still have from upper management some broad goals, because that's what upper management's job is to do. Set some profitability goals for the firm, okay? Maybe some earnings per share goals. Right? Of course, macro events happen and all those get thrown out the window, as we've seen in recent times. But at least you start with a plan, okay? So why decentralized operations? Here's some of the pros. It allows upper management to work on the bigger issues, okay? Bigger issues like, should we merge? Should we repurchase shares? Should we increase or decrease the dividend? Should we issue more common stock? Obtain bank loans? Okay, should we expand internationally? Should we add another product line? Think of McDonald's a few years back. They added salads because they thought that would make people bringing their kids to McDonald's who clamored to go there for the Happy Meal kits. You guys probably have some of those toys in your closet. The parents might be able to get a salad, a healthy salad, rather than some chicken nuggets and fries. Okay, so do we expand our product line to include salads? All right, General Motors or Ford. Let's take a look at Ford. Ford's cutting back on the sedans that they produce. They're concentrating more on trucks. Okay, Tesla is electric vehicles. That's mandated from the top. Okay, but upper management makes those decisions. Boeing, we're going to have the 737 MAX. Ooh, and then we did some cover-up. Okay, those are upper management decisions to expand to the 737 MAX. Do we fly internationally? Now, in light of coronavirus, airlines are cutting back. Okay, so some of them have said, we know you don't want us to fly to Europe or to China. In fact, we're going to curtail 70% of our operations. I don't know, by the time you view this, Maybe they will be totally shut down. Maybe we'll be starting to gear back up. All right? Now, continuing with the pros, lower management, who's in the trenches, knows what things should be done to accomplish daily operational goals. Maybe they know that someone should be fired. Maybe they know who the right people are to work overtime. Maybe they know certain orders need to be expedited for certain customers. All kinds of operational issues that they should be making those decisions, okay? Kind of going along with that, quicker response. Customer calls up and needs a part. The lower level manager can make that decision and expedite that, overnight shipping. Maybe send someone out, drive over to so-and-so's supply house and get them these products. They need them today, they're a good customer. Maybe it's a new customer and you want to make them happy, okay? So quicker response than going through bureaucracy, okay? Additionally, your lower level management is getting trained to become upper level management because they're making all these daily decisions. Hopefully this stuff is making sense to you, all right? If lower level management is empowered and they get to make little decisions like purchase a new machine if it's under a certain amount of money, if they're given a budget, hire another person, implement overtime, give someone a raise. That empowers that manager to become a better manager and maybe move up the ranks, okay? Improves firm-wide motivation. What do they mean when the text tells us it improves firm-wide motivation? It means that you now feel like you're contributing, okay? It's your game plan that's being implemented in your department, okay? They set the goal, they want a certain profitability, but you're setting the game plan on how to achieve the results. So when it works, you feel good about yourself. Your employees feel good about contributing to the team or the division's results. And the other thing it does, when you empower your lower level management and your employees, okay, you end up creating a lot of product and service expertise because they feel like it makes a difference to them. So they become real good product experts, okay? All those things are really good. Now there's always consequences. There's always good things and bad things. So some of the cons, bigger picture may be misapplied. So yes, we've been set a profit goal from upper management, and we're kind of told we can get there any way we want, okay? But are you stepping on some of your stakeholders' toes? In other words, are you becoming profitable but you're creating pollution? Are you becoming profitable because you cut down on contributing to the Boys and Girls Club or the Little League team or something like that? So you might want to be a better corporate citizen up at top, and maybe some of your divisional managers are not doing that, okay? Consistency throughout the firm. Everybody wants certain things to look and feel a certain way, and maybe your division found out that a little bit of a change in the packaging or something would be more efficient, but then you don't get your branding and your logos out quite the way you want. Okay, so consistency when it's not heavy-handed up at top sometimes can be jeopardized. The objectives of managers at different levels might not always coincide. Okay, so there could be some friction between the different management layers because they're not centrally controlled. The other thing is, when you do have a good idea and it works in your department, how well or quick is that great idea, which might help another department disseminate it, okay? So centralized operations, when stuff is found out good, it's let everybody know. In a decentralized operation, that might be best for the firm, but we don't know how quick you are to let your other division manager friends find out what's going on. The other issue is, sometimes it leads to excess and overstaffing, okay? So, number one, we might find some efficiencies if we merged our divisions, but I'm gonna run my division, you run your division, and we don't find out that we could have worked together on certain things and been more efficient, okay? So why do we go through these pros and cons? To kind of explain why we're gonna do some of the math in this chapter, okay, which tracks how divisions are doing. Gives you different tools on evaluating how divisions are meeting their goals or not meeting them. And finally, to answer a brief essay question, list a couple of pros and cons of having a decentralized operation. Shouldn't be too hard, open book test. Okay. Now, moving on, any questions? Just email them, okay? Now, there's 3 centers of responsibility that the book talks about. One is a cost center. We've been dealing with those all term, okay? Cost centers are those divisions or services like we've talked about: cafeteria, janitorial, HR, admin. They're not making any product, but you need them. Legal, accounting, you need them to run a corporation. None of them are producing revenue. They're just costs. So we have to allocate those costs, okay? So we're gonna do it a little differently, but not too much so that you shouldn't understand how to allocate costs from support to other parts of the company, all right? We've done that all term. The second area of responsibility are profit centers. Profit centers are those departments that are generating revenues. Not only is the profit center management responsible for growing revenues, they also need to manage the cost of their department, okay? So the support center or cost center, they're trying to provide the assistance to the other divisions at the least cost most efficiently. The profit centers are trying to generate the most revenue and less expenses or increase profitability. And finally, there's the investment center. When we're talking about investment center here, we're not really talking about stocks and bonds. What we're talking about are the assets that generate revenues for your company. Do we purchase the property, plant, and equipment? Do we lease it? Okay. How many assets do we give one division versus the other? If we're an oil company, how many assets do we deploy to oil exploration, and how much assets do we deploy to increase the gasoline stations that we have across a particular country? Okay, we're going to look at the profitability of different divisions. We're going to look at them in a couple of different ways. All right. So again, cost centers are things like the HR, the legal, R&D, advertising, admin. Those are all cost centers. Profit centers are those divisions that are making the product that you're going to sell. Okay? And the investment center, think of this CFO. They're in charge of making sure that when you acquire property, plant, and equipment, you're getting good financing on the project, okay? You're buying it or you're leasing it, okay? And other big ideas like that require the deployment of assets, okay? How are we gonna move our assets around in this company to get the best profitability? All right, hopefully that gives you a little bit of an idea on the difference between cost, profit, and investment centers. All right, so now on page 475 of your text, they have some examples there and a little bit of discussion on analyzing this stuff, all right? Trying to give you ways of understanding whether your department is doing well, all right? What does that deal with? It deals with return on investment. Return on investment is earnings before interest and taxes, which sometimes we call net operating income, and sometimes we just call it operating income, but earnings before interest and taxes over invested assets. Invested assets, as I just alluded to, are things like your property, plant, and equipment, okay? They are not things held for investment, okay? They're not the stocks and bonds that a company bought investing in another company. They are not land that you bought speculating that the land will go up in value. Yes, it is the land that you bought where you're going to put your property, plant, and equipment, okay? How do you know? You have to look at the balance sheet, you have to talk to people so that you know there's land on the books. Is it land for property, plant, and equipment that's generating revenue at your firm, or is land that you bought because you're holding it for future sale, okay? That is not part of invested assets when we're trying to determine return on invested assets, okay? We won't trick you like that. The problems that I pick, the invested assets are the invested assets, okay? Now, this is nice. This is a high-level look. How much is your operating income over your invested assets to get return on investment? We'll look at a problem in a moment. What we've done here, the book points out to you, is DuPont, which is a chemical and oil company, okay, came up with their own expanded version of this formula. They broke it into two items. EBIT over sales. We should recognize that as profit margin, okay? Or operating margin, to be more precise. I think the book calls it profit margin, but it's really operating margin because it's before interest and taxes. Times your sales over your invested assets, okay? What does this mean? That's showing you when you invest in assets, how much in sales are you generating? Here it's saying how much operating income do you get out of every dollar in sales. If you're good at math, you'll notice when you multiply two terms like this, you could cross out sales and what's left, EBIT over invested assets, return on invested assets. So both of these will result in the same answer. It's just when you use it in the DuPont equation version, you get a little bit more information. You'll finally end up with the same ROI, but you'll also get profit or operating margin, and you'll get asset sales turnover number, which gives you some insight to, are you controlling your cost, and are you generating enough sales based on the assets invested in you? So it gives you a little bit more insight as to why you're succeeding or not succeeding. Are your costs too high relative to sales? Are your sales not high enough relative to the amount of assets that the investment center has given you? Okay, so the investment center gave you a level of assets. Are they generating an appropriate amount of sales? You have a certain level of sales, but what is the cost to get them? It looks at these separately to see if you get some insight as to where you're either doing well or poorly internally or compared to other departments, okay? All right, let's take a look. And again, if you have a question, normally I'd say stop me. Well, I guess you can. You can hit pause, send me an email. All right, so you can still stop me. All right, if you want, you can pause this and go back at any time. This will be out here for at least 30 days. I'll see about extending it, but you should be watching this sooner rather than later, just as if it was your scheduled day. Because you want to look at this, and then you're going to want to do your homework. The homework due dates haven't changed. Okay, I want to kind of stay on plan. All right, hopefully you can see this will make it a little darker. Those of you in the back row, any complaints? Don, I bet, has already emailed me 2 very good questions. That's great. I'll try to reply to those to all of you. So when one person has a question, I will repeat the question. I don't need to tell who sent it, but I will reply to it to everybody so we'll know what your peers are thinking are interesting questions. All right, so here we're going to look at this return on investment, okay, return on invested assets. This is actually problem 1013, I believe. Yes, so this is one of your assigned homework problems. I'm going to email you this file. You may already have it. It'll be posted under the Learning Module tab of Blackboard. It's the Learning Module. So it'll be right next to the video. That'll be also posted under the Learning Module tab on Blackboard. Okay, 1013 gave you what looks like an abbreviated income statement. We've been working with these all term. Sales, less cost of goods sold, that's product cost. Give you a gross profit, subtract the administrative type expenses or SG&A, and you have earnings before interest and taxes. Okay? If someone just asked you, what is the return on invested assets? We can quickly figure that out. Okay? And we have $39 million in EBIT. We have $230 million of sales. So we got our EBIT over sales. That's 17%. 39.1 divided by 230,000 is 17%. And then we take the other half of the DuPont equation, sales again. So this was EBIT over sales. This is sales over invested assets. This $143,750,000 is given to you in problem 1013. This divided by this is 17%. This by this, sales divided by invested assets is 1.6. So you know you're creating $1.60 in sales for every dollar in assets. You know that you're generating operating income at the rate of 17 cents for every dollar of sales. Multiply those two numbers. 17% times $1.60 is $27.20. That is your ROI. That is your return on investment. Yes, you could have just went and took EBIT of 39.1 and divided it by 143,750, the invested assets. You would have got the exact same number. This is giving us more insight as to why we're getting 27.2 ROI. It's because we're earning $1.60 in sales for every dollar of invested assets, and because we're getting 17% of operating income from every dollar of sales. If this number is lower than what was mandated, we could take a look at our expenses. Maybe we should reduce our expenses. Maybe we just need to generate more sales. It will depend. It will depend on what your division manager in a decentralized operation thinks is the best way to increase this ROI. In this problem, 1013, they suggest reducing your cost of goods sold or administrative expense by some $3 million, what was it exactly? $3,450,000. So they tell you to reduce your expenses by $3,450,000. If we reduce our expenses, that's going to increase our EBIT by $3,450,000. Hence, this $42,000,005. I don't know if you can see this on the video. This $42,000,005 is this number, B40 plus $3,450,000. So the new EBIT is higher when you reduce expenses. We'll have more operating income if you reduce expenses. By reducing expenses, it increased our profit margin, our operating margin. 19% times 160, because we didn't change the invested assets and we didn't change the level of sales. But our ROI increased to 29.60. We could have also got the 29.60 by taking the new EBIT and dividing it by the invested assets. So we've increased our return on investment by squeezing some cost out of the operation. That's something a division manager should know. They might know we can cut back on overtime. They might know Joe and Sue are lazy workers. Fire the two of them and hire Susie. Susie works twice as fast as either one of them. We just cut salaries. We eliminated some overtime. We got rid of dead weight employees. Maybe we buy a new machine that works faster. Whatever it is, that division manager has been set to get a higher ROI, decides that the best way is this, and they work on reducing the expenses to increase the operating income, okay, which increases operating margin. Again, I will send you this file, all right? So that's one way to see, are you meeting the goal? Where is the issue? Should we increase sales? Should we reduce the assets invested? Or should we reduce costs? So 3 different things this gives you an option to do. Increase sales, reduce cost, which increases operating income, or do it with less invested assets. That'll increase your profitability also, okay? Think of true-false type questions. How do you increase ROI? Reduce the invested assets. Increase sales. Increase EBIT, which also kind of means lower expenses. Any of those would be correct answers. All right. We'll turn this off for a minute. That's 10:13, so you don't have to do 10:13. We already did that one. We're going to do 10:06 in a minute. Well, maybe in 5 minutes or less. We'll turn this off. I'm going to wake you up again. Turn the lights back on. Okay. And what do we need here? We are going to look at another concept to see how we're doing. All right? Before we attack that, I'm going to erase this. If I erased it and you didn't write it down, don't fret, just rewind or look at the notes. It's in the notes. Okay. We're going to introduce a concept that you are only going to need to know from a very high level. Okay, if you take my Finance 350 course, Chapter 10 really tears it apart, weighted average cost of capital. All you need to know for your purposes is it will be given to you. Okay? You'll also need to understand a weighted average cost of capital at a high level when we get to Chapter 12, which is capital budgeting in our accounting class. WACC, that is weighted average cost of capital. I don't like just giving this to you and saying I'm going to give you the number using the formula, okay? I think that's the lazy way out. I want to explain to you what it is. Weighted average cost of capital is the cost to finance your operations. How does a company finance its operations? Primarily through 3 securities: corporate bonds, common stock, and preferred stock. All right? You won't see this in the notes here. In Chapter 10, weighted average cost of capital is mentioned. How do we get to weighted average cost of capital? We look at how much you pay in interest on bonds, how much dividends you pay on preferred stock, how much dividends do you pay on your common stock, and how much is your stock expected to go up in price, the common stock. We call that capital appreciation. So here they're looking at the interest rate. Maybe you're paying 6% on your bonds. When you finance with bonds, you get a break. If you were in the 33 1/3% tax bracket, that means 1/3, okay? You get to multiply this by 1 minus the tax rate. You don't have to do this for Chapter 10. WACC will be given, but I want you to know how we got there. 6 times 1 minus 1/3 equals 6% times 2/3, which equals 4%. All right? So hence, your after-tax cost of the bonds to the corporation is 4%. Common stock, maybe you're paying a $2 dividend. Say the stock is $40, that's the stock price. If you're paying a $2 dividend, 2 over 40, what is that? 2 over 40 is 5%. That sounds right. Okay, that equals 5%. And let's say you thought the stock was going to go up 4% this year from $40 to $41.60. That's an increase of 4%. Add that, and this stock is costing you 9%. The preferred stock, maybe you paid $100, you sold it for $100, and you're paying an $8 dividend. $8 dividend over a $100 investment is 8%. For simplicity purposes, let's say you raised $100 million, 33 1/3 million in bonds, 33 1/3 in common stock, and 33 1/3 in preferred stock. They call that target structure. We don't need to worry about it. But if we did each of them individually, then we'd say 9 plus 8 is 17, plus the 4 is 21. We add the 3 of those up, divide by 3. Weighted average cost of capital then would be 7%. All right? You don't need to do this until you take my corporate finance class. You will need to do all this. All right? Which happens to be Chapter 10 in corporate finance. I think we've got someone here who should understand that. Okay. So anyway, the weighted average cost of capital considers your interest expense, your dividends and capital appreciation, and dividends on preferred stock. And you get this amount. Why is this important? It's important to know what this is because you should not invest in any project at your corporation that doesn't give you a return of at least 7%. Because if you're borrowing money or raising capital that's costing you 7%, you don't only want to earn 4% on that. You need to earn more than 7% to show profits. Hopefully that makes sense. So that's what this number is. It's setting a floor on what all projects have to earn, or else you don't invest in the project. Okay? Weighted average cost of capital. The number that you will be given indicates the minimum you need to earn on a project, or you do not invest in that project. All right, so let's look at an example here. All right, I've already started this. We're given earnings before interest and taxes, and we're given the invested assets. So we can calculate ROI. We'll do it the simple way, EBIT over invested assets. $100,000 of operating income, $1 million of invested assets, that's a 10% ROI. $120,000 EBIT in your other division, so this is one division, this is the second division. $120,000 of operating income, $1.5 million assets, so that investment center CFO gave this person 50% more assets to work with. They made $120,000, they earned 8%. Okay, that was their return on investment. Both of those hopefully are greater than the weighted average cost of capital for this firm. So let's take a look. The residual income method discussed in the book, all right, is a different way to look at this. So at first blush, okay, let's say weighted average cost of capital for this firm was 6% given. Both of these divisions are achieving their goal. They're earning an ROI greater than WACC. So that's a good thing. They're both contributing to the profitability of the firm. A new way to look at it, or a different way to look at it, is how are they doing given this minimum number? All right, so what do we do then? We take this 6%, we multiply it by the $1 million. Okay, so we say 6% of $1 million is, for part A, 60,000. The cost of the weighted average cost of capital is $60,000. 6% on 150,000. 6% times a million, 6% of 1,500,000. Get your calculators out, you should have them. Okay, that's 90 grand. So B, the cost of WAC, is 90,000. Now let's check the profitability of these two departments. The first department was making 100 grand. The financing of that department, because of the amount of assets they had, at 6% is 60 grand. So the 100 minus 60 is 40,000. They're making money. They're making 40 grand. The second division made 120 grand. The cost of financing is 90 grand. 120 minus 90, they have a $30,000 profit. They're both profitable. This one's more profitable. And when we look at this, it even looks even better now. This was good. We knew they were doing a better ROI. But not only that, they made 40 grand on $1 million of assets. Once you considered the financing costs. They only made 30 grand and they had 50% more assets to work with. This department really looks much better. We might want to consider, if we're the investment center CFO, to redirect some of these assets here. Or maybe we want to, if we're going to raise more assets, they get the next batch of them. Because they're doing better both on an ROI and a straight nominal profitability number. How did we get here? 100 grand over $1 million is 10%. 120 over $1.5 million, 8% ROI. Both of these are better than WAC. Both departments are doing a good job. Who's doing better? Let's take a look based on the financing cost of 6%. That's what it's costing you to finance. 6% of the million is 60 grand. 6% of $1.5 million is 90 grand. Subtract the 60 from 100, the 90 from 120. We get 40 and 30. They're really killing it. More profits on much less assets. Okay? All right. Now let's change it up a little. We know the Federal Reserve has been crushing interest rates lately to stimulate the economy. So we now have, let's say we now have WACC of only 3%, because the Federal Reserve is reducing it, trying to encourage people to use assets. The cheaper it is, the more easy it is to finance projects. The hurdle rate is lower. 3%, both of these still look good at 10 and 8. So now what am I going to do? We're going to take 3% times $1 million. 3% times $1 million is 30,000 of WAC costs. For B, 3% of $1.5 million, that's 45,000. Obviously, they have more weighted average cost of capital cost because, again, they have more invested assets they're using. But now let's look at what happens to profitability. The 100 grand minus 30, they've made 70. The 120 minus 45 is 75,000. If you're able to borrow at cheaper money, it reduces the onus of using more assets. In fact, Division B now becomes more profitable on a nominal basis. Yes, they're only making 5 grand more and they're using a lot more assets, but at least they're making more than the other division, okay? So it just gives you a different way of looking at things, all right? They are making more than they are if we could reduce financing, because then the assets aren't as big of a burden because you're financing them at a much lower rate, 3% versus 6%. Which is why when we read in the Wall Street Journal that the Federal Reserve pushed interest rates to zero, they're trying to get those corporate bond rates down so companies can invest. All right, hopefully this makes sense to you. All right. You have a homework problem that will look a lot like this. All right, and hopefully that will shed further light on it. You could rewind. All right, next thing, I think I have another homework problem. Actually, I got two that we could go over. First one's not numerical, but it'll mean you don't have to do 10-3. So if you open your book to page 492, it's got several items listed there, A through F. Okay, it says for each of the following support departments, so these are cost centers, identify the driver that could be used to allocate that support department's cost up the line to different profit centers. Okay, so for legal expenses, maybe you have 6 different divisions in your company and you have a law department. What would be a good way to allocate those legal costs? Maybe based on the number of hours your lawyers spend working for each division. So hours worked for other divisions would be the way to decide how to allocate the legal costs. How about duplication services? The office room with the copy machine. Easiest way, every department has a code. When they come in to use a copy machine, they slide their card through just like we do, and it tallies up how many copies each employee makes. We know what division the employee works in, so we can allocate the cost of the copy center to the appropriate division based on number of copies made by employees in that division. Electronic data processing. Okay, maybe we can do it by the number of pages viewed on the computer. Maybe CPU usage time. Maybe based on pages printed from people directing it from the computer. Whole bunch of different ways, okay, that might make sense on how to fairly allocate the cost of the people working in the support or cost center of the computer department to the various departments. Central purchasing, maybe on a number of purchase orders that they fulfill for each division that's selling different products. So if one department sells 10% of the product and each percent needs a purchase order, and another department sells 90% of the product for that company, and they use 90% of the purchase orders, and the purchase department cost 100 grand of staff, 90 grand goes to the one department, 10,000 of the cost is allocated to the other. Just like we've been doing all term. Telecommunications, number of phone calls, number of minutes, something like that would be a fair way to allocate the cost of the phone system in the company. And accounts receivable could be based on the number of customers that each department has, okay? So what they're trying to do in 10.3 is remind us that when we start allocating costs in a couple of these problems, we have to use a rational way of doing it, okay? Why do we want to use a rational, objective way to do it? So the division managers think we're being fair in how we allocate the cost to them, because their job is to lower costs. They don't want to be getting a burden of extra cost assigned to them. So you want to explain, if you're running the support center, why you're charging them X number of dollars for office expense, or copy machine usage, or phone usage. You could tell them it's based on how many pages were printed by employees in your department. Hopefully that makes sense to you. All right, this one we already did, so you don't have to do 1013. And we'll now eliminate 10.6 from things you have to do. Darken it up, don't fall asleep. Surprised nobody's had any questions yet. Oh, I gotta check my email. Maybe there's a few there. All right. Again, I should caution you, you wanna review this video before Chapter 10 homework is due. It will help you do Chapter 10 homework. And it's eliminating a couple of the problems that you had to do. All right. 10.6 said there were 4 support centers: the help desk, the network center, the electronic email department, and the smartphone. The drivers for the help desk are calls. For network center, it's devices used. For electronic email, it's the number of accounts that are open. In smartphones, it's based on how many were issued to employees in your department. It tells you what the budget or cost of each of these support centers was. So the help desk, which uses calls, spent 90 grand, okay, to provide the service of answering your customers' product questions. How many calls were made? 3,600 customers called in. 90 grand divided by 3,600 is 25. Remember, I'll send this to you. So I just put it in a simple Excel sheet. This divided by this is 80. 32 and 18. We now know per unit what each of these cost. So once we know the cost per unit of all the different support things that we do, we can now allocate. Here we're going to allocate to the communication department. It's given the communication department has 2,500 employees, and 20% of 2,500 is 500. Those are office employees that use these services. Okay? The other 2,000, maybe they're factory workers. They're not using this. 500, 20% of the 2,500 are office employees that use these 4 services. What does it tell us? It tells us all 500 employees have, I gotta double check that as I look at this. All 500 employees have smartphones and email accounts. I think it's 475 if I'm reading the problem right. And 475 have email accounts. Okay? All right, so all 500 employees have smartphones, 475 have email accounts. 95% of the 500 employees have computers. Okay, all this is given. 60% of the employees with computers is the average number of help desk calls. So they take the number of help desk calls times employees, 60%, that gives us 285. We just have to read the problem. When I get to the practice test and the final exam, I'll try and clean this up and word it much nicer and put it in the same order so it makes some sense. It also tells us that there were a total of 875 devices used, 475 computers, and then they told us another 400 devices, printers and other things. And it tells us to allocate the cost. So then it should be rather simple. Our cost allocated, the help desk, it was 25 bucks a unit, 285 people used it. Networks Center, $80, 875. That was the 400 printers and the 475 computers. That's 875. Multiply it, you get 70 grand. Electronic email, 475 people. 95% of the people that had smartphones was 475 times 32, 15,200. Smartphones, all 500 office workers had smartphones. 500 times 18 is 9 grand. Boom, there it is, $101,325 allocated. We've been doing this allocation all term. It's just from a different perspective. It's allocating the cost center to a specific division, different drivers, really not unlike what you should already be familiar with, okay? That's 10.6. Hopefully you don't have any questions on that, but if you do, just send them in. Remember, I'll send you this file. I'll make sure I change that 475 and turn this off. We're getting close to the end here. Aren't you glad? Well, it didn't matter. You could stop it and watch it later. Oh, woke you up. Got the light back on. Now you can see me. The last topic on the notes is transfer pricing. Transfer pricing refers to how do you allocate cost of purchasing products. So product cost. Here we were talking about support costs. Phone, HR, R&D, email, okay, all those costs. The different divisions. But what about the product cost? All right, so I'm going to end up having an example here that we'll walk through. But when we're talking about transfer pricing, it might mean, and the example that we're going to use will be a bicycle factory. The bicycle factory may make spokes and rims and tires and pedals and chains. They might make a bunch of the parts and then assemble them. So you'll have different departments that are responsible. One department makes spokes, one makes rims, one makes tires. Another one makes pedals. Another one makes handlebars. Another one makes a seat. And another one makes the frame. And then they all get sent to the assembly department who puts them together, and the bike gets sent out to finished goods and sold, and hopefully we make a profit. Okay, now, the issue is, in the factory that we're going to talk about, they are going to make 50,000 bicycles. Bicycles means 2 tires per bike. So if they're making 50,000 bikes, they're going to need 100,000 tires. Oh, this one's dying. $50,000 bikes means 100,000 tires. Okay, now, the issue becomes, how big is your factory? And let's say your factory is plenty big to build, to make pedals and handlebars and the frame, but they only have capacity to make 80,000 tires. Where do you get the other 20,000 tires? Very good, from another supplier. You will buy the extra 20,000 tires that you need from a supplier. And in this case, the supplier that you found that will give you the best price, so the market price of the tires that you have to buy, is $65 per tire. So you're going to buy 20,000 tires at $65 each. You're going to make 80,000 in-house. You're going to buy the other 20 grand. That'll give you 100,000 tires, which is what you need for 50,000 bikes. So far, I think you're following this. Okay? All right. So where are we at? Again, decentralized operation. The manager of the bike tire department knows this is going on. it only costs them $40 to make the tires when they make them in-house. It keeps thinking, it would be great if we didn't have to spend $65. It would be much cheaper for me to make them in-house. So he brings in an engineer or two. They observe the operations. They talk to the employees. They do a little retraining. They speed up a couple of the machines. They get a better oil so that the machines could go faster. They throw in a little extra air conditioning so the guys and the ladies on the factory floor aren't feeling overworked as much. And lo and behold, they have now figured out that they can produce 110,000 tires. They've increased capacity. Decentralized operations got the manager of the tire department to figure out a way to solve the problem of having them go to a supplier and pay all this money. We don't need this person anymore. They could make 110,000. We don't need 110,000, so they're going to only make the 100,000 that we actually need. Maybe we expand in the future, make more bikes, they can make more tires. Maybe they'll make some 110,000 tires and sell 10,000 tires to someone else who needs them. We don't know, but for right now, we'll concentrate on the fact that they're solving our supply chain issue. They're now making 100,000 tires at $40 a piece. So how much better off is our firm? The firm, the corporation as a whole, is buying, this is called incremental analysis, 20,000 tires, $25 cheaper, right? 65 minus 40. This is what you paid the supplier, and this is what it cost you to make them in-house. $25 cheaper. That means we're saving $500,000. 25 bucks times 20,000 units. We went from making 80,000 to 100,000 in-house. We're saving $25 a unit. We're saving the firm $500,000. So now transfer pricing says, how do we allocate this $500,000 in savings? They tell us we could do it 3 ways. Market pricing. Let's do that one first. Market pricing says the assembly department was paying $65 before. So we're going to allocate a cost of $65 times 20,000 tires, because this was the market price. This is what you were paying the other supplier. Okay? So that entire amount is going to be charged, to the assembly division. That's market pricing. You use the price that the other department was paying the supplier. All right. Number 2, we use transfer pricing. So somewhere along the line, someone decided that the appropriate way to do things is to create transfer pricing. Maybe it'll be 20% over cost. So if it's costing $40 for this department to make it, they get to charge you 40 times 1 plus 20%. That is $48 a tire. Okay? $48 a tire. Or number 3 is a negotiated price. In a negotiated price, I know it's, as the production manager here, it's costing me 40. The assembly division knew they were paying 65. We're gonna come to some term somewhere in the middle between 40 and 65. Maybe 50. So now you transfer the cost of those extra 20,000 tires and $50 a unit to the other division. That's the negotiated price. So you do it at the market price, what they were paying before. You can do it at some predetermined rate, 20% over cost. So that would be the cost of 40 bucks, what it cost at tire department to make it, times 1 plus the markup, 48 bucks. So you're gonna tell the assembly department, we're gonna allocate you 48 times 20,000, or what's that, $96,000 worth of cost. Here was a $130,000 worth of cost allocated on those extra tires. Here at 50 bucks, okay? 50 bucks a tire times 20,000 is 100 grand. Now we know the firm in a whole is better off by $500,000. In this case, when we use market pricing, the assembly department is in no better position because all the costs are being allocated to them. The $65 is the same that they were paying before. Transfer and negotiated pricing, both departments will show some improvement. That's the point. So again, we have to decide at each company, both divisions have to work something out where both feel fair. This isn't going to necessarily be the one that's going to make both departments happy. So either some kind of transfer pricing or negotiated price will be used. Okay, they have a homework problem or two that should, think number 17 and 18, which should enlighten you a little bit more on this. I will work this one out also on Excel, include it with the 2 homework problems, and zap it out to you. That concludes my discussion on chapter 10, with the exception of reminding you that the homework is still due on the due date for chapter 10, 11, and 12. Read the notes, look at the text, watch the video, rewind the video, delete the video, read the notes, read the chapter, do the homework problems. Have a good day.